Time is the real currency of money. Most people approach investing as if it were a technical activity, choosing assets, opening accounts, following trends. That is surface-level thinking. The real foundation is far more structural. Money is not static. It is a representation of stored human effort. But unlike effort, money does not preserve its value in a fixed way across time. Time changes the meaning of money. What you hold today is not the same as what it will represent in 5 or 10 years. Not because of subjective perception, but because of systemic forces that operate continuously in the background of the economy. The most important of these forces is time itself. Time determines whether capital expands or decays. It determines whether an asset compounds or stagnates. It determines whether an investor becomes richer or remains trapped in illusionary stability. The mistake most beginners make is assuming that holding money is neutral. It is not. Every unit of currency exists inside a moving system. Prices shift, productivity increases, markets evolve, and economies expand. If your capital is not actively positioned within that system, it is effectively being diluted by default. This leads to a fundamental principle. Investment is not about choosing opportunities. It is about preventing decay. To invest is to accept a trade-off. Immediate liquidity is sacrificed in exchange for exposure to long-term expansion. Without this sacrifice, there is no growth, only preservation. And even preservation is an illusion when inflation exists. The investor who understands time does not ask, "How much will I gain?" first. He asks, "What is the cost of waiting?" Because waiting is never free. Inflation, the structural leak of wealth. Inflation is often misunderstood as a temporary rise in prices. In reality, it is a structural feature of modern economies. It is not an accident, it is embedded in the system. Its effect is subtle but consistent. It reduces the purchasing power of currency over time. This means that holding cash is not a neutral decision. It is a negative yield position disguised as safety. The danger of inflation is not its visibility, it is its gradual nature. People adapt psychologically to price changes, and this adaptation hides the underlying loss. What cost $100 10 years ago does not cost the same today. But the human mind normalizes this change, interpreting it as cost of living instead of currency erosion. This misinterpretation leads to one of the most common financial errors: excessive saving without productive deployment. Saving alone does not protect wealth. It only delays its degradation. The only rational response to inflation is to seek assets that generate returns above the inflation rate. Not occasionally, not sporadically, but consistently over time. If your returns are below inflation, you are not investing. You are slowly liquidating your purchasing power without realizing it. This is why many systems that appear safe are actually structurally weak when examined over long horizons. Even banking systems, in many cases, offer returns that do not compensate for inflation, especially when considering taxes and opportunity cost. The key strategic shift is this: stop thinking in terms of profit and start thinking in terms of real return. Real return equals nominal return minus inflation. Only positive real returns create true wealth expansion. Everything else is erosion with delay. Compounding, the only scalable wealth mechanism. There is a point in financial systems where effort stops being linear and becomes exponential. That point is compounding. Compounding is not complex. Its power comes from repetition, not sophistication. It works through a simple mechanism. Returns are reinvested, and those reinvested returns generate additional returns. This creates a feedback loop where capital begins to grow based on itself, not just on new input. Most people underestimate this because early stages appear insignificant. Growth is slow at the beginning, almost unnoticeable. This is where most investors abandon the process. But compounding is not designed for short-term observation. It is a long horizon structure. Its true force appears when three conditions are met: consistent return generation, continuous reinvestment, extended time exposure. Remove any one of these, and the system weakens significantly. Withdrawals are particularly destructive. Every time gains are extracted, the exponential curve is reset or flattened. The system loses momentum. This is why disciplined investors often appear patient rather than active. Their advantage is not frequency of action, but continuity of structure. Compounding rewards those who remain in the system longer than others can tolerate. It is not a tool of intelligence. It is a test of discipline. And discipline, not knowledge, is what ultimately separates capital accumulation from financial stagnation. Structural preparation before exposure. Markets are not designed to protect participants. They are designed to allocate capital efficiently under uncertainty. Entering them without preparation is not participation. It is exposure to volatility without defense. Before any investment strategy is considered, two structural elements must exist. 1. Liquidity buffer. A reserve of capital that covers basic living costs for several months. Its purpose is not growth. Its purpose is stability. Without this buffer, any unexpected event forces liquidation at the worst possible time. This converts temporary volatility into permanent loss. Liquidity is not idle money. It is strategic defense against forced decisions. Debt control. Debt is not inherently negative. Its impact depends on cost and structure. High-interest debt creates a system where financial pressure grows faster than investment returns can realistically compensate. This creates a structural imbalance. Your liabilities grow faster than your assets. In such conditions, investing becomes mathematically inefficient. The correct sequence is non-negotiable. Stabilize liquidity, eliminate high-cost debt. Only then allocate capital into growth assets. Skipping this sequence does not accelerate wealth. It amplifies fragility. A financially unstable investor is not an investor. He is a leveraged participant exposed to forced behavior. Markets punish forced behavior. Investment systems and strategic allocation. Once structural stability exists, capital can be deployed into productive systems. There are multiple investment instruments, but they should not be treated as isolated options. They are components of a larger system. Equity ownership, stocks, represents participation in productive enterprises. When businesses grow, capital appreciates alongside them. Returns depend on business performance, not speculation. Index-based systems, ETFs/funds, these instruments distribute risk across multiple companies or sectors. Their strength is structural diversification, reducing dependency on individual outcomes. Fixed income instruments, designed for stability and capital preservation. Lower volatility, lower return, but important for balance in a portfolio system. Alternative assets. Real estate, commodities, and digital assets introduce exposure to different economic drivers. These are not replacements for equities, but extensions of diversification strategy. However, the critical insight is not the instrument itself. It is allocation logic. Markets reward structure, not randomness. Concentration increases risk exposure. Diversification distributes it. But diversification must be intelligent, not emotional. Owning many assets without understanding them does not reduce risk. It multiplies ignorance. A portfolio is not a collection of assets. It is a reflection of your understanding of risk, time, and economic behavior. Finally, entry strategy matters more than entry timing. Capital does not need to be large to begin. It needs to be active and consistent. The objective is not immediate return. It is system learning under real conditions. Because future capital will be larger, and the ability to manage it will determine whether wealth expands or collapses. The market does not reward intention. It rewards structure, patience, and execution under uncertainty. Investing instruments and how money actually grows. If you already understand the basic idea of investing, the next step is to stop thinking in theory and start thinking in structure. Money does not grow randomly. It grows inside systems. And if you don't understand those systems, you are not investing, you are guessing. There are three main types of investment instruments that shape almost every modern portfolio: stocks, funds, and fixed income products. Each one behaves differently, and each one responds to different levels of risk, time, and discipline. Stocks represent ownership. When you buy a stock, you are not trading numbers. You are buying a fraction of a real company with real operations, employees, debt, products, and future expectations. If that company expands its revenue and profits over time, the market usually rewards that growth by increasing the price of the stock. But this is not automatic. Markets are emotional in the short term and rational only in the long term. This is where most beginners fail. They confuse price movement with value creation. A stock can fall even if the company is improving. A stock can rise even if the company is weakening. The market is not a moral judge. It is a perception engine driven by expectations. Then you have funds, especially index funds and ETFs. These are not individual bets. They are systems of diversification. Instead of trying to select one winning company, you buy an entire group of companies in a single structure. For example, an index fund tracking large companies spreads your risk across multiple sectors and reduces dependency on a single outcome. This is not exciting, but it is mathematically efficient. Most individual investors fail not because they choose the wrong system, but because they try to outperform systems they do not understand. Fixed income products, such as bonds or deposits, operate differently. Here, you are not buying growth, you are lending money. You accept a predefined return in exchange for stability. The trade-off is clear: lower risk, lower return. Higher risk assets offer growth potential. Lower risk assets offer survival and stability. A rational portfolio understands this hierarchy: stability first, growth second, speculation last. Now, the deeper concept behind all of this is not instruments, It is allocation. Wealth is not created by picking assets. It is created by distributing capital intelligently across time horizons. Short-term capital must remain liquid. Medium-term capital can tolerate moderate risk. Long-term capital is where volatility becomes acceptable, because time absorbs uncertainty. This is why professional investors think in decades, not days. Time is not just a variable. Time is a risk management tool. And this leads to a hard truth. Most people are not underperforming because of lack of opportunity. They are underperforming because of lack of structure. Without structure, even good decisions produce inconsistent results. Investing is not about finding certainty. It is about building a system that survives uncertainty. Inflation, interest, and the hidden mechanism of money loss. The first silent force that destroys savings is not market crashes. It is inflation. Inflation is not visible in a dramatic way. It does not attack suddenly. It erodes slowly, consistently, and without attention. When prices increase over time, the purchasing power of money decreases. This means that holding cash is not neutral. It is a negative position in real terms. You are not keeping money safe. You are accepting guaranteed loss of value relative to goods and services. This is the fundamental misunderstanding most people carry. They believe that not investing is safe. In reality, not investing is a position, just a poorly structured one. If inflation is, for example, 3% annually, any investment that does not exceed that threshold is not real growth. It is stagnation disguised as safety. Real investment begins only when returns consistently exceed inflation after taxes and fees. This is where psychology becomes dangerous. People are often attracted to extreme promises, high returns with low risk. But in efficient markets, risk and return are structurally linked. If something promises high returns with no risk, you are not seeing the full system. You are seeing a marketing layer. Historically, many financial collapses come from this exact distortion. When expectations detach from real productivity, capital flows into illusions. Now introduce compound interest, which is the opposite force of inflation. Compound growth is not linear. It is exponential reinvestment of gains. The key mechanism is reinvestment, not income. Money that generates returns and is reinvested stops behaving like capital and starts behaving like a system. Each cycle increases the base for the next cycle. This is why early capital matters more than most people realize. Time amplifies capital more than effort alone. The difference between simple interest and compound growth is not mathematical. It is structural. One is static, the other is recursive. However, compounding only works under one condition: discipline. If gains are withdrawn, the system resets. Most investors destroy compounding through impatience. They extract short-term gratification at the cost of long-term acceleration. This is where behavior overrides intelligence. Knowing about compounding is common. Acting in accordance with it is rare. There is also a strategic contradiction. The same people who fear risk destroy growth through inactivity, and the same people who chase growth destroy compounding through impatience. The solution is not more knowledge. The solution is consistency of execution under a defined structure. At the core, investing is not a financial problem. It is a behavioral constraint system. The market does not reward intelligence alone. It rewards patience under uncertainty, and that is where most participants fail before they even begin to compete.